Welcome back to the deep dive. This is where we take the sources you give us, dig in, and pull out those key insights. Basically a shortcut to getting informed. Today we've got a really interesting stack. It's all real-time market analysis, trading protocols, detailed timelines, all focused on September 10th and 11th, 2025. Our mission, well, it's to sort of peel back the curtain on these advanced automated trading systems, see how they make decisions, especially when things get volatile.
Yeah, it's fascinating stuff. We're really getting a look at what's called dynamic discipline in action. So you won't just see the trades, you'll see the sophisticated logic behind them, the risk management, especially around a big event like the CPI data release that's coming up. It's really quite a masterclass in automated strategy.
Okay, let's start with September 10th. Set the scene a bit. This day was apparently so good they called it a gold standard closing bell report.
Yeah.
The market backdrop was described as risk-on but fragile. And there's this one system, OMNI Profit Nexus, that just had a brilliant day. We're talking about this golden window, right? Between 9:30 a.m. and 11:00 a.m. Eastern, this system, 9 trades, all winners. They called it a 90-minute mastery pattern.
9 for 9.
And the gains were pretty impressive, those TSLA 375 calls, up to, what, plus 133% on one lot? And even SPY 654 call scalp brought in over 14%, a 100% win rate across those 9 trades. Just incredible.
And if you look at the bigger picture, this wasn't just luck or smart picks. It was really about time arbitrage.
Yeah.
The system basically exploited that morning window,
Yeah.
where you often get institutions rebalancing, and it meets that wave of retail FOMO, the fear of missing out.
Okay. Capitalizing on that morning rush.
Exactly. Get in, grab the gains, and then get out before the afternoon gets messy with all that algo-driven shop, the high-frequency noise that can just eat away at your profits.
Makes sense.
But here's where it gets really interesting, I think. Even with that perfect score, the Alpha Core V4.0 analysis, that's another system layer, it actually issued a warning. It said, and I quote, "A 100% win rate sessions are statistically concerning. Expect mean reversion."
Wow. Okay, so perfection itself is a red flag.
Kind of, yeah. It raises that question. Can winning too much be a signal? It led to recommendations like, aggressively bank those profits, maybe even reduce your trade size for the next session, because the odds of repeating that perfection pretty low. It's a key lesson in market dynamics, right? Whether you're human or code.
That's a really powerful insight. Okay, so let's fast forward. September 11th, 2025, the present day in this scenario. And the big event looming is the Consumer Price Index, the CPI data. That drops at 8:30 a.m. Eastern, a major market mover. Now, to handle this, it's not just one system. There are several working together, right?
That's right. It's a whole suite. You've got the OMNI Profit Nexus as this sort of overarching framework, setting the main rules. Then Alpha Core V4.0 is doing the live trading, the tactical stuff. DOTAS V2.0 is like the intelligence unit, market intel, tactical assessments. You've got the CSASC model looking at cross-asset stuff, portfolio strategy, and the ultimate engine ties it all together under this balanced hunter mode.
A lot of moving parts.
It is. And what's really remarkable is how they all converge to create this unified strategy. They're crunching just tons of data to figure out the market regime. And on this day, heading into CPI, it was identified initially as low volatility transitional.
Okay, what does that mean exactly? Low volatility transitional.
It means things were quiet, but maybe, just maybe, about to change. The market's calm, but there's potential for a shift. So the goal is to balance being aggressive, looking for opportunities, with being really careful about risk, especially when the VIX, that's the volatility index, the fear gauge, was down around 15.35.
Right. A low VIX usually means calm, good for stocks.
Generally, yeah. It creates what the system's called an optimal hunting ground for options. Because low implied volatility means options are cheaper, so you can get more bang for your buck if you catch a move right. The lesson for us, is that understanding that volatility backdrop is just as vital as finding the trade itself.
Gotcha. So the overall market sentiment for the 11th, it was described as aggressive bullish. But, and this is key, with underlying fragility and caution. Kind of a contradiction.
It seems like it, doesn't it? But that's the nuance. On one side, yeah, you had the low VIX supporting the bulls. SPY was up. Bitcoin looked okay. But these systems were digging deeper. They were seeing warning signs, too.
Like what kind of warning signs?
Well, remember those afternoon fades from the day before, where the market rallied early but couldn't hold it? The systems noted that. It suggested maybe real money wasn't chasing the breakout, a lack of conviction from the big players. They also picked up on an institutional bias to sell the rips in SPY. So any pop was seen as a chance to sell, not buy more.
Okay. Not exactly raging bullishness underneath.
not entirely. And for TSLA, despite its big day before, the short-term signals were flagged as neutral bearish. And maybe the most interesting one was Bitcoin, or rather, the Bitcoin ETF. There was this caution flag because of a divergence.
A divergence.
Yeah, the ETF itself looked bullish, price was rising, but the actual underlying Bitcoin spot price, it was softening, going down slightly. That hinted at potential ETF overextension. Like the ETF price was running a bit too hot compared to the real asset.
So the system is basically saying, okay, be bullish, but watch out for these cracks.
Precisely. It's that ability to hold both ideas. Be aggressive, but be aware of the fragility and plan for both scenarios. That's the sophisticated part.
Okay, so with all that complex insight, how did the plan, the Hunter protocol for AlphaCore v4.0, actually translate into trades? It kicked off pretty early, right? Immediate execution orders at 7.15 AM ET, well before CPI.
Yep. Didn't wait around. They established initial positions. The main ones were a SPY call, SEP12 expiry, 654 strike. It was 5% allocation called the anchor. Then a TSLA call, SEP12, 355 strike, 4% allocation, the amplifier.
Yeah.
And a Bitcoin ETF call, SEP19 expiry, 50 strike, also 4%, the swing position.
So that's 13% initial exposure in options right before CPI. That feels gutsy.
It does, and for a lot of human traders, that would be tough. But here's the discipline part again. These weren't just blind market orders thrown out there. The O&M profit nexus rules stepped in and refined them to stop limit entries.
Okay, stop limit. Why is that important here?
It's crucial, especially before CPI. It helps avoid getting terrible prices if the market gaps wildly right after the beta release, you know, those CPI gap fills. A stop limit gives you more control over your entry price, prevents huge slippage. It maintains discipline even when being aggressive.
Right, avoiding that instant whipsaw. Makes sense.
Okay.
Then comes the main event, 8:30 AM ET. CPI data hits the wires.
Yeah.
What was the protocol then?
Very clear. No trading.
Just stop.
For the first 2 to 5 minutes, yeah. Just let the initial chaos, the knee-jerk reactions play out, let the dust settle a bit, then reevaluate. And they had a plan B ready.
A contingency plan.
Absolutely. If volatility spiked after CPI specifically, if the VIX jumped above 16.5, the system was prepped. It was ready to execute an SPY straddle. That's buying both a call and a put at the same strike, the 654, 650 strikes in this case, with a 3% allocation. That play profits if SPY makes a big move, either up or down.
Betting on the size of the move, not the direction.
Exactly. And that was paired with buying VIX calls SEP 1818 strike using 1.5% allocation. That's a direct hedge. If volatility explodes higher, those VIX calls should pay off. It's really about anticipating multiple outcomes and having a specific response ready for each one.
That's some serious preparation. So pulling this all together, the risk management, this balanced hunter mode, what does that look like day to day? It sounds like a mix of aggression and, well, strict rules.
That's exactly it. Strategically aggressive, but with discipline control. It starts with how they size positions. Using a hypothetical $1,000 baseline, maybe $650, $700, so 65–70%, is for active trading. But a good chunk, 300, 350, or 30–35%, is held back, kept in reserve for pivots, hedges, unexpected moves.
So not putting all the chips on the table at once.
Never. And individual positions are capped, max 5% of capital per trade. And for those really risky 0 DTE options, the ones expiring the same day, the limit's even tighter, max 2% per trade because of that heightened event risk, like CPI.
Okay, careful sizing. What about stopping losses?
Non-negotiable hard stops, defined for each asset. Like for SPY, if it drops below $651, the system exits, no questions asked. TSLA, below $345, Bitcoin ETF, below $49. These are crucial safety nets.
Predefined exit points.
Absolutely. But then there's the ultimate backstop, the kill switch. This isn't triggered lightly, only under really extreme conditions. The rule was, if SPY falls below $640 and simultaneously the VIX spikes above 18...
Both conditions have to be met.
Both. If that happens, boom, everything is flattened, all positions closed immediately. Think of it like the emergency brake on a high-speed train. You hope you don't need it, but it's there to prevent a total disaster.
A Ferrari with exceptional brakes, as the note said.
Exactly. And on the flip side, profits aren't just left to run wild either. They're taken systematically using tiered exits or profit ladders. Predefined targets, T1, T2, T3. You hit a target, you take some profit off the table. This avoids overstaying your welcome, especially if a breakout looks like it might fail, like those afternoon fades we talked about.
Scaling out of winners locks in gains.
Right. The big takeaway here, really for anyone listening, is just the absolute necessity of having those predefined risk limits and a clear profit-taking plan before you even enter a trade.
That discipline is key. Okay, but how do these systems get so precise with their entry and exit levels in the first place? They seem to know these key prices. The sources mention things like Fibonacci levels.
Yeah, they lean heavily on technical analysis tools, and Fibonacci retracements are a big one. Like you saw TSLA pre-market around $351. That was just nudging above its 23.6% fib level at $350.69. SPY was pushing right up against its 0% fib level, basically the recent high, around $654.55. That's a natural resistance spot. And the Bitcoin ETF was holding above its 38.2% fib level at $50.42.
So these aren't random numbers. They're seen as important psychological or structural levels in the price action.
That's the idea. They often act as thresholds where buying or selling pressure might change, but it goes deeper than just fibs.
Okay.
This is where it gets into market mechanics. Systems also map out gamma walls and analyze something called convexity.
Gamma walls, convexity. Sounds complex.
It can be, but the concept is important. Think of a gamma wall as a price level where a huge number of options contracts are clustered. For SPY, they saw one forming around $654, $655. Now, why does that matter? Because options dealers are often short gamma at these levels. If the price pushes through that wall, the dealers are forced to buy the underlying stock, SPY in this case, to hedge their options positions. That buying pressure adds fuel to the move. It creates this accelerating effect, a convexity cliff, where the move can suddenly get much bigger, much faster.
So breaking that level triggers more buying, which pushes the price higher still.
Yeah.
A feedback loop.
Exactly. And they saw something similar for TSLA around the $355 strike. They called it a gamma flip zone. If TSLA reclaimed that level, it could trigger a similar explosive move. Understanding where these zones are lets the system target points where returns could potentially amplify exponentially.
So it's not just price levels, but the options market structure around those levels.
Precisely. And speaking of options, the Bitcoin ETF options market was really interesting. It was massively skewed towards calls, like 4.2 times more call volume than put volume. And importantly, the implied volatility was cheap.
Okay, lots of call buying, but options weren't expensive. What does that signal?
It signaled traders weren't selling premium, they were buying convexity. They were making relatively cheap lotto-style bets on a big breakout to the upside. It showed a strong underlying belief in potential explosive gains for the ETF, even with that spot price divergence we mentioned. Recognizing these hidden forces is key.
Fascinating. Okay, let's quickly recap the specific takeaways for each asset based on all this system analysis. For SPY, the picture was kind of coiled, right? Just under resistance. Needed more buying volume to really break out.
Yep, needed confirmation. And underneath that warning about potential institutional distribution, selling into strength.
Okay.
TSLA.
TSLA was at a decision point. Technically, it looked maybe oversold, like it could bounce. RSI was low. But sentiment-wise, shorts were piling in. Analysts were still kind of skeptical longer term. A real battleground.
And the Bitcoin ETF.
Generally bullish, strong momentum on the chart.
Okay.
But that big caution flag was the misalignment between the ETF price and the actual Bitcoin spot price,
Yeah.
signaling that potential overextension risk. Got it. So each asset had its own unique story, its own set of risks and opportunities, even within the broader strategy.
Absolutely. It highlights the depth, doesn't it? These systems aren't using a blunt instrument. They treat each part of the portfolio with its own specific analysis, sensitivities, triggers. It's definitely not one size fits all. And for you listening, the point is that even when the overall market looks one way, say bullish, the individual pieces can be telling very different complex stories. You need to dig into those specifics.
Well, that really was a deep dive. We've gone from a perfect trading session to the intricate planning for a volatile CPI day, looking at everything from entry tactics to risk management to gamma walls. It's a fascinating mix of aggressive plays, but wrapped in incredibly tight disciplined risk control.
It really is. The precision, the adaptability, it's quite something. But it does leave you thinking, doesn't it, as these highly disciplined automated systems become more dominant in the market, how do we as human learners adapt our own approach, our own understanding of risk, of opportunity? Are these systems just reflecting the market back at us, only faster and more efficiently, or are they actually starting to shape market behavior themselves?
That's a big question. Definitely something for you to ponder. Thanks for joining us on this deep dive. I hope you're walking away feeling a bit more informed and maybe a little more curious about the complex machinery moving behind the market ticker.